What I would be careful about, though, are certain industries. So I want to go through some industries now that in a $25,000 portfolio or less, I would completely ignore. Hey everyone, this is Ian. I'm back with another video about dividend growth investing. So I've been traveling the last few weeks. I'm finally home again and excited to be filming a video here again from my home turf. Today's video is a very exciting one. It is a video about how I would personally invest $25,000. If I were starting over again, I had $25,000 to invest. Today's video discusses that very topic. Now, I have already filmed videos on this very topic for $1,000, $5,000, and $10,000. Today is about $25,000. So I consciously don't want to repeat the lessons of the last three because these videos build. So if you do want to check out those videos from before, please look in the description below. I'm going to include links to all three of them. So today's video, I'm just going to start with the big difference when one is investing $25,000. The number one risk investing $25,000, in my opinion, is investing in too many stocks. So I invest for dividends and cash flow, so I'm approaching the question today from that perspective. My incentive for investing is not for capital appreciation. Capital appreciation, or the stock going from here up to here, is very nice, but that's not what it's all about for me. What it's about for me is receiving dividend checks in the mail on a regular basis that I can use to fund my living expenses. So I invest in companies that pay increasing streams of dividends over time. I've seen this time in and time out. I've seen this in my own portfolio. I've experienced it over the years. I've seen it online in reading blog posts and watching other videos, in reading the comments on various YouTube channels. The biggest risk with investing $25,000 for dividends and cash flow is just buying too many stocks. It gets exciting, especially because in the world of dividend growth investing, one is buying stock and holding it pretty much forever. I never intend to sell. I just like the money to compound over time. I reinvest the dividends. The companies raise the dividends each year. The companies keep growing. And I like holding on forever for that reason. It maximizes my returns over the long run. But it can get boring. And here's the risk for dividend growth investors. Because it gets boring, because one's not trading, one's not buying and selling, one's not booking those gains or locking in those gains, it gets boring. How do dividend growth investors compensate for that? They buy too many stocks. They buy way too many stocks. And they dilute their performance, because when one buys too many stocks, one is diversifying. They're diversifying into stocks that are going to hold them down. Now, my personal portfolio contains over 30 stocks. It's taken me a long time to get where I'm at today. I would say I probably have too many stocks. That said, I don't have equal weighting in all of these. In some of my big positions, I overweight time and time again. I really overweight. So if you look at all the positions in my portfolio, quite different amounts in each of them. And so I've kind of overcome the diversification challenge by overweighting in those stocks that I truly love. That said, I have had to pare back my portfolio over the years. And some people have asked, hey, Ian, you say in these videos you never sell. But in fact, I see you commenting sometimes, hey, I had that stock and I sold it. I might buy it back. I might not. The reason for this is I've had to pare back my portfolio. So I intend to never sell stock. But just like all of you out there, I face the same struggles with dividend growth investing. I have a lot of years behind me. I've been doing this for over 20 years. That said, I'm still learning, I'm still improving, and one of the challenges I faced in more recent times has been pruning the portfolio, keeping it at a reasonable level. I can say with confidence that the 30 plus stocks I own now, I love all of them. Could not say that a few years ago before I started the pruning. But again, the biggest possible mistake that one could make with $25,000 is just buying too many stocks. One probably couldn't make this mistake with $5,000, $1,000, or $10,000 in that range, because it's not enough money to necessarily buy too many stocks. Commissions would get out of control. It just logically wouldn't make sense unless you're really going on a different path to have a ton of stocks with less than 10,000. But when one is at $25,000 and they're investing that much, the natural tendency is to buy too many stocks. So what would I do with $25,000? Personally speaking, I would buy 5 stocks. I would just buy 5,000 in each, and I would keep them in these industries. A lot of repeat from the last videos, but some new twists here as well. Actually, new twists not only for this video, but I also almost wish I could kind of retroactively update the other videos, because I think these thoughts are relevant to those ones as well. So first thing I would do is I'd buy a big healthcare stock, pharmaceuticals, medical devices, healthcare. That's a growing industry. Demographics are in one's favor. And let's face it, we all want to live long and healthy lives. So if one is going to allocate money towards something, I'm not talking about stocks here, just your money, one is always going to spend it on health in living. That's the most basic of human needs. And so that's where I would focus first. I would also buy a consumer non-cyclical stock in food and beverage industry. We all have to eat. I would buy a consumer non-cyclical stock in basic needs like diapers and shampoos and that kind of thing. We all have to live life, and we need those products to live life. Here's where it gets interesting, and here's the twist from the other videos. Maybe with the other 2 stocks, I would just repeat the 3 themes already discussed. Quite frankly, in my opinion, one could do very well in dividend growth investing just focusing on these three themes, in my opinion. Healthcare, consumer non-cyclical food and beverage, consumer non-cyclical basic needs. So even for the $10,000 portfolio, which I just discussed, one may want to do that. It may not make sense to add in more industries. Even for portfolios greater than $25,000, in my opinion, it is totally fair to say, hey, I want to focus, and I want to focus on these 3 industries. Doesn't mean you only buy 3 stocks. You could buy 2 stocks in 2 of the industries. So one of the industries, you'll hold 1 stock, the next industry 2, the next industry 2, 5 stocks. Or one can break my rule and say, hey, Ian, I don't want to do 5 stocks, I'm going to do 3. And I would totally agree with that as well. And so I just want to underscore that these are the 3 industries, in my opinion, that will continue to thrive. They will continue to be around forever. They will continue to see dividend increases with the best blue chip companies. They will continue to reward shareholders like you and me. But let's say, hey, Ian, I don't feel good about just 3 industries. I want to add 2 more. Here's the 2 more I would add. I would add industrials, so companies that make things like elevator equipment, airplane parts, that kind of stuff, furniture parts and housing materials, those kind of things, appliances. These industrial type companies, in my opinion, will continue to do well, especially if one focuses on a non-cyclical or relatively non-cyclical industrial. And the reason for that is the global population continues to increase. And so an industrial that has a focus, especially on emerging markets, should continue to do well as worldwide infrastructure increases. So the last industry that I'd probably add, and this is a more steady eddy, stable one, would be a regulated utility. Regulated utilities are great. They do have a lot of debt. It's characteristic of the industry, but the debt can be managed because they're essentially, in my opinion, a government-mandated monopoly. New entrants cannot come into the market. It's a regulated market. The prices are regulated. The companies work with the government to increase prices over time. The yields are great. The yields don't grow very quickly, but the starting yields are great. And for someone at a $25,000 range, gives you a little bit money in year 1. Not necessarily that you need to tap into that money or live off the money in year 1. You probably want to reinvest it, and that's what I would do over time, and then tap into it later when the portfolio has reached a greater value and one is getting closer to living off dividends or partially living off dividends, supplementing lifestyle with dividends. But that said, the beauty of a $25,000 portfolio is one could theoretically start tapping into that in year 1 And a regulated utility would bump that up a little bit. Here's something I want to point out in today's video also that's different than the other videos. And this applies to the $1,000, the $5,000, and the $10,000 as well. Let's say you want to ignore what I'm saying so far, and that's great. I'm just speaking from what I would do, hypothetically here. Let's say you want to take a different path. That's great. What I would be careful about, though, are certain industries. So I want to go through some industries now that in a $25,000 portfolio or less, I would completely ignore. Now, don't get me wrong, these industries are good. I own stocks in these industries. I have a big portfolio, so I can do that, and I can allocate to these industries in very bite-sized amounts. But for a $25,000 portfolio or less, I personally, hypothetically, if I were putting myself in that situation, would not invest in these industries. First one, energy. Who the heck knows what is going to happen with oil over the long term? It's a commodity. Price of oil may go up, price of oil may go down. What I do know is there's a lot of trends right now towards batteries. Battery-operated cars, electric cars, the battery-operated house, solar paneling, all kinds of solar, renewable energy, alternative forms of energy that could potentially place challenge on the oil energy, traditional energy industry over time. Now, obviously, oil will always have its uses. Oil has use in manufacturing, it has use in airplanes, all kinds of things. It's not going away. That said, for a $25,000 portfolio, I just wouldn't want to take that risk of exposing myself to the energy industry. The great thing about the energy industry is one can get some short-term good yields, great starting yields. Stocks are relatively depressed since the price of oil has fallen and not yet recovered. They started to recover. They're not there yet. $25,000 or less, I would not go near the energy industry. Next one, REITs, real estate investment trusts. One of you out there, or several of you out there, have asked me about real estate investment trusts. I own one of them in my portfolio. I'm going to discuss that in a future video. For a $25,000 portfolio or less, I would not expose myself to real estate investment trusts. The reason for this is real estate investment trusts have different tax consequences than qualified dividends. Most of the companies in the United States out there pay what's called a qualified dividend. Qualified dividend is typically taxed as long-term capital gains, or for most people out there, 15%. Real estate investment trusts pay dividends. They avoid double taxation. And by avoiding double taxation, they have to distribute a big lion's share of their earnings, and it's taxed at a higher rate at the individual level. And so when one receives a dividend from a real estate investment trust, it is taxed differently. It's oftentimes taxed as ordinary income, which is a higher tax rate. If you just watched my video on peer-to-peer lending, very similar to that. And some portion of it is oftentimes treated as return of capital. So in addition just to the tax stuff, there's different accounting for that. And what I'm saying is at a $25,000 level, does one want to add more complexity to their tax return? No. I would do that when the portfolio got bigger and the money was flowing in and one could afford the time or the resources to hire a tax advisor to help. But with a $25,000 portfolio, in my opinion, it's not worth it. That's not what I would do. But with a larger portfolio, certainly some exposure to real estate investment trusts could make sense, and I'll discuss that in a future video. Next one, I would completely avoid technology. Most companies these days are exposed to technology. Healthcare, that's exposed to technology. It's exposed to medical advances. Consumer non-cyclicals, they use technology to power their companies, to make their companies better. That's where a lot of the growth is coming. So with a $25,000 or less portfolio, I do not need pure play exposure to technology. Too risky. Too many ups and downs. Companies come in and out of favor. Again, in a larger portfolio, a small percentage of allocation to technology could make total sense, and I own a technology stock, a pure play. However, in a smaller portfolio, I just wouldn't do it. And not to talk down on 25,000. That's a very large amount of money in dollar terms. I'm just saying for that amount, it wouldn't warrant, in my case, exposure to technology. What else would I avoid? I would avoid cyclical stocks. Cyclical stocks can be very difficult. I own one or two of them, and it makes sense for me in a larger portfolio, but again, in a $25,000 portfolio, it's just not ever going to be the core of one's portfolio. That's how I think about it. In my portfolio, I have core stocks and I have ancillary stocks. Core stocks are the ones I was talking about earlier. I double, triple, quadruple down on them. They're disproportionately bigger in my portfolio as a percentage than the non-core stocks. Everything I'm mentioning here, a non-core stock has no place in a $25,000 portfolio or less. It may have a small place in a larger portfolio, but may not as well, because these non-core stocks can dilute performance. And so cyclical stocks, those that go way up and way down with the economy, they're highly dependent on the economy. These are the kind of stocks where they really depend on, oftentimes on B2B, business to business. They depend on other companies making investments, and other companies are only going to make investments in good times, not bad times. Whereas the companies I personally would focus on, such as healthcare, doesn't matter where the economy is going, people are always going to need to buy those products and services. What else would I avoid? I would probably avoid, or not only probably, I would avoid retail. Retail is a tricky sector right now. There are a lot of changes happening. I'm sure all of you out there have seen the news with Amazon.com and some of the shopping malls closing, some of the major retailers of the past filing for bankruptcy. There are retailers that make sense. I own retail stocks. I wouldn't own them in this scenario. I consider retail stocks ancillary stocks. They could dilute one's performance and create risk. The last sector I would probably, or not only probably, again, I would avoid would be restaurants. Restaurants, again, I kind of lump with retail. Things are changing. Things are changing quickly. Just wouldn't need that exposure in this portfolio, in a $25,000 hypothetical portfolio. So I'm going to do a quick rundown now just on some of the other things I would do. This is more summary from the prior videos. I would focus on stocks that have world-renowned names, blue chip stocks, brand name stocks. I would focus mainly on larger companies. With a $25,000 portfolio, I would range them a bit. I wouldn't go sub probably $3 billion market cap, but I'd go anywhere from $3 billion to hundreds of billions, and I would have the average weighted size in upwards of 100 billion, so I'd skew a little bigger on market cap for the stability. I would focus on companies that have a very manageable amount of debt. Interest rates are low right now, not always going to be that way. Not always going to be that way. I love companies that manage their debt wisely. Not all of them do. A lot of companies have been taking out debt to buy back shares, to push up their earnings. In my opinion, that's just financial engineering. Maybe it has a time and place. I'm not a CFO. I'm not, I can't claim to be as wise as some of the CFOs out there, but I generally find it to be financial engineering. So I stay away from it. I like manageable amounts of debt. I would focus on stocks that have a current yield of about 3%, somewhere between 2 and 3.25, somewhere in there. And then I would focus on stocks that raise the dividend year in and year out over time, looking at historical records, anywhere probably between 4 and 7%. When you're buying 5 stocks, maybe you can't find all of them yielding 7% returns, increases in dividend year after year. That's fine. Anywhere between 4 and 7 would probably do well. So the current yield is 3, but they have a historical track record of raising the dividend each year pretty consistently, and it's anywhere each year, year in, year out, the raise is anywhere between 4 and 7%. What else? I would leverage dividend reinvestment plans. I would reinvest all the dividends. I would stagger my investments so that I don't put all $25,000 in at once. I'd probably do $5,000 per month, stagger it in over time to eliminate market volatility risk. And most importantly, I would have a cash buffer. With a portfolio of this size, $25,000, it's going to be tempting to tap into it when times are bad. So in 2017, I would certainly try to have an emergency fund, whereas when I went all in the Great Recession, I did not have an emergency fund. It was a conscious choice. It was risky, though. If something happened to me, I would have had to tap into my money. 2017, the valuations are really high. Not all of them, but a lot of them. Because the valuations are higher, I wouldn't take that risk anymore. Maybe if I were just starting out, I would. But in general, hypothetically, 25K, I wouldn't, because it would be too tempting to tap into that investment portfolio if anything happened in life. Here are the numbers. If I start with 3% yield on cost, starting yield. If the company's raised at 7% year in and year out, the dividend over 30 years, I'm ending with a 23% yield on cost, on my original cost, original purchase price. With $25,000 investment, this means after 30 years, I'm receiving $5,750 per year in dividend income. And this is very conservative because it does not take into account reinvesting dividends over a year, which would balloon this number even more. And it doesn't look at capital appreciation, but I don't really look at it because I'm a dividend investor. With $25,000 investment, even at 3% in the short run, one is getting $750 per year. So even the starting dividend income is pretty good. And that's nice. I mean, look, if something happened in life and one didn't want to reinvest dividends anymore, they needed to tap into them. It's nice to have an extra $750 per year to tap into. That is the power of dividend growth investing. So this is how I would invest $25,000 from a dividend growth investing standpoint. I hope today's video is helpful. I do encourage you to check out the description, the other videos, the related ones on 1,000, 5,000, 10,000. I really wanted to focus today, though, on new content, new stuff, which is really the industry analysis. And I hope that industry analysis was helpful because once you've narrowed down your industries, then it's easier to find stocks. You just select the best stocks in that industry and research them very heavily. One question I've received on my channel is, Ian, how do you research stocks? What are the metrics you look at? I will be doing that video. I thank you for your patience. I've actually been planning it out. It's going to be a very long video. Might even be an hour in length. We'll see. So it required some preparation, but I will get to that video. So hang tight. Thank you for that question and hang tight. So this is Ian Lopuck, ppcian.com. As a friendly disclaimer, I'm not a licensed investment advisor, and today's video is not investment advice. This is just for your fun and entertainment. I'm just sharing my passion here on YouTube. If you are going to go out and invest capital, please do consult a licensed investment advisor first. Also, before we leave, thank you so much for the questions, comments, likes, subscriptions. This is what fuels my channel. So if you enjoyed the video today, if it was helpful at all, it would mean the world to me if you could just give me a like, a comment, if you could subscribe. Thank you in advance. It means so much. And please keep the questions coming. I will get to all of them in future videos. Here's to our collective success in the world of passive income and cash flow. Let's keep those dividends rolling in. Let's invest in those dividend paying companies, hold them forever, hold them for a long time, and just watch the dividends grow year in and year out. I will see you in the next video.